And that is the bell. Markets are officially closed for Friday, January 23rd, 2026.
Right.
And I have to say, looking at this tape, usually Friday afternoons are for, unwinding, checking out early.
Right.
But today,
Hmm.
today was an absolute street fight. We have zero pleasantries. We have too much tape to cover. Let's get straight to the scoreboard. Because if you just glance at the headlines, you think, okay, quiet dead.
You would be dead wrong.
Dead wrong. It is a split decision to end the week. The S&P 500, it managed to eke out a gain, closing up 0.16%.
Barely.
The Nasdaq 100 edged out a finish, up just 0.1%.
Yeah.
But then you look at the Dow.
Oh, yeah.
It is the ugly outlier here, dropping nearly 300 points. That's down 0.7%, a massive divergence. And looming behind all of this, you've got the bond market screaming for attention.
Yeah.
The 10-year Treasury yield is breaking out, sitting right at 4.26%.
It was a choppy mess. Honestly, looking at the intraday action, mess is really the only word for it. It's a very mixed signature.
Mm-hmm.
You've got yields pushing up against equity valuations. You have this rotation that just feels violent under the surface. And you have the indices trying to figure out if bad news is good news or if bad news is just, well, bad news.
It certainly felt like we were fighting for every single basis point. So how do you characterize a session like this?
Yeah.
Because we opened ugly.
I'm calling this a repair day. And to understand why, you have to think about where we started. Remember the open?
Oh, yeah, a gap down.
The big gap down, and we had those polar vortex energy fears spiking nat gas, plus the absolute anchor that was Intel dragging the entire semi-space down. It looked like the floor was falling out. It really did. Look like a liquidation event.
Well, we didn't stay there.
No. And look at where we finished. We staged a classic outside day reversal.
Okay, so for the listener who might not be staring at a candlestick chart right now, break that down. What is an outside day and why should they care?
Essentially, the market price range today just completely engulfed the previous day's range. We opened, we probed the lows aggressively in the morning, looking for sellers. But the crucial thing is, we found no conviction from the bears.
The selling dried up.
It dried up, and when it did, the buyers stepped in and just ground the price all the way back up, closing higher than yesterday's high. We went from deep red to green, at least for the S&P and the Nasdaq. It signals the bears took their best shot, and they missed.
So we repaired the technical damage from that morning gap. But, technicals usually need a fundamental excuse. The algos don't just buy reversals for fun. They need a trigger. What was the catalyst? What flipped that switch?
It's the return of the taco trade.
Taco. T-A-C-O. I'm assuming we're not talking about lunch.
Yeah, no. Trump always chickens out.
The geopolitical game of chicken.
Exactly. I mean, think about the narrative all week. The market's been hypersensitive to this Trump-Greenland tariff story. The bots, the HFTs, they were programmed to sell any escalation.
Which is why we were so heavy in the morning.
Precisely. But this afternoon, right around that reversal point, we got the headline that the administration is de-escalating through a new U.S.-NATO framework.
So the temperature came down.
Immediately. And that just erased the risk premium. You know that relief rally we saw on Thursday from the Greenland stuff? It evaporated this morning, but then this news triggered that risk-on reversal late in the day. The market realized the tariff threat was a negotiating tactic, not policy.
So the geopolitical bark was worse than the bite, and the bid came flooding back in. But I have to push back a little here. It feels, hesitant. We aren't exactly ripping to new highs. If this taco trade is so powerful, why aren't we seeing a massive green candle?
That's a fair point, and it's because we're in a holding pattern. The taco trade fixes the immediate geopolitical jitter, but the elephant in the room is next week. We have the first FOMC rate decision of 2026.
The Fed.
The Fed. Investors are squaring their books. Nobody wants to be a hero in front of the Fed, especially with yields creeping up to that 4.26 level. You buy the relief, but you don't bet the farm.
You cover your shorts, maybe add a little exposure, but you're not leveraging up.
Exactly.
Well, speaking of not being a hero, we have to talk about the disaster that was Intel. I mean, we can't gloss over this. It's the entire reason the Dow looks so ugly. Intel collapsed, 15.6%?
We can't ignore it. It was a bloodbath. There's really no other way to describe it.
Disastrous guidance. The stock opened with a massive gap down. And usually, when a blue chip name like that drops 15%, you expect some kind of dead cat bounce, right? Some value buyers step in.
You'd think so.
It found zero buyers. Zero. It closed at the dead low of the session.
And that is the most concerning part for any Intel bulls still out there. There was no intraday support at all. This thing's technically broken, When a stock closes on its lows on massive volume, it tells you institutions are just hitting the eject button at any price.
They're not looking at PE ratios.
No, they're looking at risk management. Until we test that $42 support level, institutional appetite is, I think, non-existent. The market is telling you the turnaround story is paused at best.
However, and this is where the tape gets really, really interesting and where the active traders made their money, the sector itself didn't die. Intel imploded, but look at the rest of the chip space.
It's the anti-Intel trade. We've seen this divergence for years, but today it was just stark. Intel's pain was directly the sector's gain.
The scoreboard totally backs that up. AMD rallied 2.85%. NVDA up 1.41%.
And that is the market being incredibly efficient. The street read Intel's supply chain warnings and terrible guidance, not as a systemic slowdown, but as a specific Intel-only execution failure.
So Intel's loss is market share gain for AMD and NVIDIA.
It's brutal Darwinism in real time.
Yeah.
It is. And it tells you that the AI CapEx cycle, the spending on AI hardware, it isn't dead. The money is just becoming incredibly selective. They're not selling chips. They were selling Intel.
I want to confirm that with the flow data. I was watching the MOC, the market on close imbalances.
Yeah.
For the listener, these are the massive block orders from institutions right at the closing bell. Despite the wreck in Intel, institutions were buying the close in big tech and AI hardware, specifically names like Micron and Western Digital.
And that confirms the rotation thesis. They didn't flee the sector, they just rotated into what they see as value tech. Micron and WDC are cyclical plays. Buying them into the close, pinning the tape near session highs.
That shows the dip buying reflex is still very much alive.
Totally. I mean, think about it. If institutions were genuinely terrified, they would have faded that rally into the close. They didn't. They bought it.
Let's verify that with volume, because we always say price is truth, but volume is the lie detector. You can fake price on low volume, you can't fake volume.
Never.
NYSE trading volume closed 18% higher than the 30-day average. That seems significant.
It is huge. 18% over average on a Friday afternoon. That is aggressive accumulation. That tells me this wasn't just retail traders playing options.
This was institutional conviction.
Absolutely. High volume on a green close, especially after a morning gap down, that is a bullish signal for the near term. It signals big money is betting this taco trade has legs, at least into Monday.
And I knew there was a but coming. You're worried about what's happening under the hood.
Yeah.
You mentioned a breath trap. What do you mean?
I am worried. You cannot trust the surface numbers today. If you just look at a screener, you might think, wow, healthy market. 68% of S&P 500 stocks are above their 50-day moving average. Advancers outpace decliners.
That sounds pretty broad-based. Why is that a trap?
It's a head fake because of the divergence. Look at the Russell 2000, small caps. It's still down 3% for the month. The S&P is flat to up. We are seeing a K-shaped exhaustion.
Explain that visualization for me. K-shaped.
So imagine the letter K. The top arm of that K is value tech. It's the mega caps. Capital is hiding there. The bottom leg of the K is speculative small caps, the Russell. They are being abandoned. It's a defensive rotation in disguise. Investors are buying stocks, yes, but they're buying the stocks that act like bonds or have these massive moats. They're dumping the risky, rate-sensitive small caps.
Yeah, so that's not the signature of a healthy, roaring bull market.
Not at all. It's the signature of a market that's scared but has nowhere else to put its cash.
So concentration risk masquerading as strength. The generals are leading, but the soldiers are getting shot.
Precisely. And that brings us right to the volatility index. The VIX.
Which got absolutely nuked today. Down, 7.5%, closing at 15.64.
It was a total volatility crash. The market moved from that risk-off spike in the morning to a volatility suppression regime as soon as the Greenland tariff threat vanished. But here's the warning. We are hitting the iron ceiling.
The iron ceiling. We usually talk about floors for the VIX.
We'll think of it as a floor that acts like a ceiling for equity prices. The VIX is sitting just above its structural floor at 14.89. It is very hard to push the VIX lower than that in this macro environment.
Why is that level so sticky?
Because at that level, options protection becomes so cheap that big funds just buy it automatically. It's like cheap insurance. When everyone buys insurance, the price of volatility has to go back up.
Right.
So to push the S&P 500 toward that 7,000 milestone, and we're hovering near 6,994 around, We need fresh buyers. We can't just rely on crushing volatility further to squeeze prices up. We're running out of juice there.
So we are at the structural floor of fear, essentially.
Exactly. And usually when you hit this floor, you get a volatile bounce. Volatility itself becomes volatile. I wouldn't be surprised at all if we see a spike early next week just because that rubber band is stretched too tight.
That brings me to the strangest part of this market. If everyone is so confident about this repair day, where is the smart money actually hiding? Because if they're buying tech with one hand, they seem to be hedging pretty aggressively with the other.
It's a barbell market. That's the strategy right now. Long risk on one side, long chaos on the other. Just look at the metals.
Silver finally did it. It pierced the $100 psychological barrier.
A massive breakout. And gold is sniffing $5,000.
That is not a signal of a calm and orderly world.
No, it is not. When you see equities rebounding, but gold and silver are ripping to historic highs at the same time, it tells you the biggest players don't trust the fiat system. They don't trust geopolitical stability. They're playing the momentum in stocks, the FOMO, but they're insuring their portfolios against a systemic shock.
It's like partying while wearing a bulletproof vest.
That's the best way to describe it.
Okay, let's get technical for Monday. We need to map out the battlefield. We've been watching the gamma levels very closely. Now, for the listener, gamma can sound like complex Greek jargon. How should they visualize this?
Just think of gamma as the market's shock absorber system. It's determined by how the dealers, the people who facilitate all these trades, are positioned. They have to hedge their books, and that hedging activity is what drives price action.
Okay, so where's the line in the sand? Where do the shock absorbers fail?
The key level on the SPY, the ETF, is 687. That's the gamma flip point.
And we close where today?
We close at 693, so that keeps us safely in positive gamma.
Unpack positive gamma for us. What does that actually mean for price action?
In a positive gamma regime, market makers are forced to trade against the trend to hedge. If the market drops, they buy. If it rallies, they sell.
Okay.
This suppresses volatility. It keeps us in a tight range. It acts like a dampener and encourages that buy the dip mentality because every dip gets bought by the dealers themselves.
So as long as we hold above SPY 687, we're in a zone where dealers are basically cushioning us.
Exactly. But, and this is the critical level for Monday, if we break 687, we flip to negative gamma.
The shock absorbers break.
Worse, they reverse. In that regime, dealers sell when the market drops, accelerating the moves. They chase the price down. If 687 breaks, the floor falls out, and selling will accelerate fast toward the 50-day moving average at 6,840 on S&P cash.
So 687 is the number to watch. Above it, we grind. Below it, we slide.
That is the game for Monday.
Before we get to specific setups, is there a barometer we should be watching over the weekend? I mean, markets are closed, but risk never sleeps.
Bitcoin.
Always.
It's the only asset that operates 2047. Watch the $90,000 level. It's the ultimate liquidity gauge. If Bitcoin holds 90,000 through Sunday night, that risk-on vibe from Friday's close probably holds for Monday's open.
And if crypto flushes.
Expect that gap down we saw Friday morning to repeat itself on Monday.
Okay, let's look ahead. Monday morning, opening bell rings. Based on everything we've covered, Intel's collapse, the rotation, the gamma levels, what's the high conviction setup?
We have to look at day two plays. The first one is obvious, and we're going right back to the scene of the crime. Intel.
You're staying with the train wreck.
There is opportunity in the wreckage. This is option A, the short side. If Intel opens flat and then breaks Friday's low, you short it.
You don't think it's oversold? No bounce coming.
Not yet. The target is $42. There is no technical support until then. It's just a void. The day two trade on a gap down like this is usually a continuation move, especially when there was zero buying support on day one.
What if it holds?
If it somehow manages to hold $46, maybe it's a tactical oversold bounce. But that is a high-risk trade. That's catching a falling knife. The trend is down, the guidance is bad, the sentiment is awful.
All right, give me a long idea. Something with actual positive momentum.
I like option B, Booz Allen Hamilton, ticker BAH.
The governing contractor. Why them?
Well, context matters here. They surged 10% on a profit beat and raised guidance. But think about the macro environment. We just came out of a 43-day government shutdown. The market is craving that safe haven government contractor status.
Right. Institutional buyers want stability.
They're rewarding it. It's the same logic as the gold trade, just in equity form.
What's the trigger for the listener watching the chart on that one?
Watch for a high tight flag. It's a classic momentum pattern. If the stock consolidates near the highs Monday morning and then breaks above Friday's peak, it has a clear runway toward $200. It's a narrative play combined with strong earnings.
Momentum plus safety. I like it.
But zoom out for a second. The real story isn't Monday morning, it's the rest of the week.
The Magnificent Seven earnings.
We have Apple, Microsoft, and Meta all reporting. Until those numbers hit the tape, the broad market is likely going to just chop wood. We're stuck between SPY 688 and 695.
So don't get chopped up in the noise. Wait for the heavyweights to pick a direction.
Exactly. Sentiment is neutral, but it's fragile. Stay lean. Don't leverage up until we see the reaction to Microsoft.
That is the print. We'll be watching Bitcoin at 90K and that gamma flip at 687. You've given us plenty to chew on.
See you at the Sunday Futures Open.